They're planning to crash everything. I'm your host, Steve Van Metre, and thanks for joining me today. A shocking report revealed that global banking elites are planning to shove the economy off a cliff. Let's head over to Wall Street Journal, where we picked today's story up with IMF warns of growing global risks. It says UK turmoil largely contained, even though it appears it's not. The Bank of England took steps to address recent turmoil in British bond and currency markets for the second straight day on Tuesday by not buying any bonds. At this point, we don't anticipate these actions being necessary in reference to more quantitative easing or bond purchases in other countries, according to the head of the IMF's Monetary and Capital Markets Department. The comments came together with the release of the fund's latest global financial stability report. It warned of heightened risk fueled by deteriorating market liquidity or the ability to easily buy or sell an asset that could combine with elevated financial vulnerabilities fueled by years of low interest rates and cheap credit to amplify future stocks. And why most people don't see this, there is evidence that there is huge liquidity problems in the market. It's not just the fact that yields are rising or the dollar's rising. There's also something we can look at called repo fails. And here you can see from the New York Fed 2 weeks ago, repo fails skyrocketed. And what this is it means that banks failed to receive or failed to deliver important collateral in transactions, either collateral they borrowed or collateral they're trying to borrow. And that is a sign of stress in the financial system, something that the IMF is not paying attention to. Mr. Adrian said the only periods when financial risks have been higher, and get that, I want to understand he's saying higher than now, were times of acute crisis such as the global financial crisis of 2007 to 2009 and the start of the 2020 COVID-triggered downturn. So I want you to understand as we go through the rest of this report that they're saying right now that we acknowledge we are on the edge of a cliff, and all we're seeing now going forward is either a financial crisis or we're going to walk back off of this and get away from it. The question is, which one do you think is likely to happen? Let's continue on because I'm going to show you they plan to shove the economy off that cliff. There's a risk of disorderly tightening in financial conditions, the report said, warning that investors could continue to pull back from global markets if inflationary pressures do not abate as quickly as currently anticipated or the economic slowdown intensifies. So what they're referring to is people's ability to buy stocks, pulling back from the capital markets. And of course, we know during periods of high inflation, when wages aren't keeping pace, it leaves less money for people to invest, and that means less money to support the markets. As markets go down, demand goes down, and then the self-fulfilling prophecy of an economic slowdown or recession takes fruit. Separately, Tuesday, the IMF released economic projections that showed global growth is forecast to slow next year. So they're already acknowledging that they are aware that growth is going to slow more than they previously expected. The IMF attributed the weaker outlook to the effects of inflation, the war in Ukraine, and the slowdown in China due to COVID-19 lockdowns. Central banks must act to keep inflationary pressures from becoming entrenched, the fund said in its report. It referenced a period of the 1970s when the Fed raised rates aggressively. I want you to know it's referring to when the Fed raised rates aggressively to bring down inflation, but then reverse course prematurely. So what they're telling you here is, look, the Fed needs to not only raise rates, be aggressive at raising rates, they need to keep them up there. That's what the report is telling you. And mind you, they just said, hey, we know we're slowing down. We know we're on the edge of this cliff, but let's keep going. For fear of inflicting more pain in the labor market than the public and Congress would tolerate, policymakers should heed the lesson of the past. And so what they're saying here is we want the central bankers to keep tightening. We want them to keep rates elevated. And the only now outcome is likely to happen is a financial crisis. And I want you to see that that's what they're telling us right here in this report. The IMF warned emerging market economies could be the most affected by any downturn, which is fairly normal, squeezed by high borrowing costs, high inflation, and volatile commodity markets. Notably, they missed the dollar shortage. Corporate borrowing costs have also jumped, the IMF said, while warning about risk in the U.S. housing market, pointing to the non-bank financial firms that play an increasingly large role in mortgage finance, but are less regulated than banks. As we pointed out on this show, those non-bank lenders are actually going to have the bigger problem of running out of business as fewer and fewer people either refinance or buy a home. That means less mortgages, less business, and their days are numbered. Policymakers should contain further buildup of vulnerabilities by adjusting policy levers, such as underwriting standards and supervisory pressure to control pockets of risk. So notably, the only two things they tell us they think we should do is either change underwriting standards or apply different supervisory pressures. Again, they're not seeing the problem as they are about to send everything off that cliff. Policymakers face an unusually challenging financial stability environment, he wrote. Risks to financial stability have substantially increased amid highly uncertain global environment. And one thing that shouldn't face financial instability is your portfolio, especially if we continue to see the IMF push the economy off a cliff. I'll put a link up here to Portfolio Shield and a description below, because the reason I wanted you to see this is because now we know that the global banking elites know exactly what they're doing. They know exactly what the outcome is, and I'll let you decide in the comments, are you looking forward to what they're up to, or do you think they have, of course, the wrong path going forward? But some good news perhaps from Bank of America that suggests that maybe everything's okay and we're just going to walk back that cliff, or not. Recession warnings are hard to find in Wall Street bank earnings, as B of A is the latest lender to offer rosy assessment of the consumer. The company was the latest on Wall Street to offer a largely rosy assessment of the U.S. consumer, as they note that B of A's credit cards jumped 13% in the third quarter from a year earlier as consumers spent more on traveling and entertainment. Less affluent customers are still sitting on savings 5 times what they had before the pandemic, a number we keep hearing, but actually it doesn't seem that way. And the number of cars and banks repossessed in any given month has now been cut in half. What it appears is that we're in the eye of the storm right now. We haven't seen unemployment tick up meaningfully yet, but we're not perhaps far off. B of A's results mirrored those reported this week by rivals JP Morgan and Wells Fargo, as all three banks saw net charge-off rates in their credit card portfolios decline from the second quarter, even as spending on the firm's cards soared, which is exactly what normally happens during periods of high inflation. We're in an environment where it's kind of odd. Consumers are in very good shape. Companies are in very good shape. Well, that may not last a whole lot longer, because we know that consumers only use their credit cards under 2 conditions. They charge extra when they believe the economy is getting better and they want to buy things now that they know they can pay for later, or they can't afford what the price is now and their incomes are not keeping up with inflation. The question is, which is it? Well, it's really the latter. The idea that the consumers think the economy is getting better isn't true. Still, it's a precarious position to be in as economists continue to warn that the Fed's move will spark a recession, leading to job cuts. For banks, losses on consumer loans historically have risen with unemployment levels. Shocking that people can't afford to make their loans when they don't have a job. If there's some form of recession, then obviously we'd expect some demand mitigation. We just haven't seen that yet. If you look at our consumer spending, it's still growing, but it's probably slowing a little from where it had been. And a lot of that is because there's a lot of hope out there. Even though consumer sentiment surveys are showing that they're at very low levels, people are hopeful that perhaps they will get wage increases, the economy will turn around. But what seems to be more likely is the economy is likely to hit a wall coming in the near future. But one thing the government's trying to do, and I'm not sure what you think about this, but they're trying to actually bring inflation down. With that, they'll actually bring jobs down as well. But let's see what the Biden administration is up to as they try to keep the economy humming. The White House is planning oil reserve release announcement this week, as the Biden administration is moving forward to release of at least another 10 to 15 million barrels of oil from the nation's emergency stockpile in a bid to balance markets and keep gasoline prices from climbing further. The Strategic Petroleum Reserve release would be the latest tranche in an already scheduled 180 million barrel program that began in the spring. The question is, do you think that this is a good idea? Should we be draining our strategic reserves, or we should let the market decide what prices are? I'll let you decide, but let's take a look at this chart, because a lot of people think inflation is going to continue to run out of control, but crude oil prices, when we start to understand these year-over-year comps, are telling us just the opposite. So let's look at WTI here, and assuming that these releases continue to put downward pressure on crude oil, what we have is WTI shown in blue on a year-over-year rate of change. Now, by late December, early January, if prices of crude oil hold their current level, the year-over-year comps are zero. And as we move into June, into the summer months, the year-over-year comps are going negative. And every time that happens, well, what do we note with the red line or the consumer price index? Well, when you start to see a negative on the blue line below the black line, you see a collapse in CPI telling us that, of course, inflation is coming down. And what does that mean? The Fed's on the wrong side of the fence. But something else that's coming down, well, that's going to be the industrial production data that's going to be hit lower in a big way. We note today the industrial production came out for September up, beating expectations of 0.4%. Manufacturing production also up 0.4%, bringing the year-over-year rate of change in industrial production up 5.33%, telling us that everything should be A-OK. But when we take industrial production, put it on a year-over-year rate of change, the blue line, and put that against the stock market or the Wilshire 5000 in red, also on a year-over-year rate of change, we note that in periods in past, the downturn in the stock market has led industrial production lower. So it is not unusual that it's hanging out here. The only question is, will it be next month, the following month? At some point, this too hits a cliff and falls off the edge. Exactly what the IMF seems to be hoping for. But will they get their recession? Will we back off the cliff? Well, it seems to me that the most likely outcome is we're headed to a financial crisis, one they know about and one they want. But for whatever reasons, I'm soon we'll find out. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.